Hi there. My name is Mike Musial. I'm a global product specialist for the securities-based lending platform at Total Bank Solutions. I'm here. We're doing a podcast for the ABA, and we're going to be discussing securities-based lending and how it can be a crucial part of a business for a bank in a rising rate and in an inflationary environment. And with me today, my guests are Russ Holland, who is CEO of Filedpoint Private Bank, and Keith Avant, who is the Chief Credit Officer. Welcome, gentlemen.
Thank you, Mike. Glad to be here.
Thank you so much for taking the time. I appreciate it. So Russ, let's start with you. Maybe start with just give us a little background on Filedpoint Bank, your history and where you're at, what your focus is, and your plans maybe for expanding in the securities-based lending environment.
Sure. Filedpoint Private Bank is a boutique private bank that was established 13 years ago by a group of New York-based business icons, including the last three CEOs of Merrill Lynch and well-known business investors like Ken Langone. They created the bank to combine both sides of clients' balance sheets, the wealth and their banking, and create a holistic approach with an unbiased, completely agnostic, advice-driven platform. We've grown to $1.4 billion in total assets with $5 billion of assets under management. And since our founding, we've been involved in the security-based lending product, and it's a key part of our business for our clients. It connects really both the wealth side of our business with the private banking side of our business.
Excellent, and I love the Merrill heritage there. I got my start there, so I have a very big soft spot for Merrill Lynch and all the innovations, which actually they were the first to bring out securities-based lending to the market. So with that, I know it's been a while. You and I started talking a couple years ago. What I find interesting is at that point, you were a little frustrated with securities-based lending business, and you had almost made the decision to sell it off altogether and let another bank handle it. And subsequently, you've not only reversed that decision, but you've kind of gone all in. So if you can maybe share, what was it that was frustrating you and making you think it wasn't a good line, and what has changed that makes you think it's something you really want to be all in on?
Sure. We never thought it wasn't a good line of business. We always understood the importance of security-based lending for our clients. However, as we grew, it was very hard to administer the portfolio properly, both on the origination side and on the servicing side, internally, through Excel-based spreadsheets and some technology. I wouldn't call it technology, some monitoring software that we kind of had developed for us that was really not scalable, and it became inefficient for us, a very costly origination process manually, and as the margins are relatively thin, it really was not a great use of our liquidity, and so we were considering having someone white label that product for us, and they own the assets and we own the client, so we could continue to offer the product, but through an outsourced arrangement. We changed our mind on that because it really didn't at all connect with our founding principles of holistic, agnostic financial advice. Having a third party involved in that piece of a client's relationship was uncomfortable for us. And so we really reached out to you, Mike, and your team to help us find a better way to originate, and a better platform that was more efficient and also scalable, and I would say a better risk profile. Manual spreadsheets and manual origination is fairly risky, especially in a volatile market. And so once we were able to find that option, we realized we could keep the product, originate it efficiently, monitor it prudently and still make some money.
Yeah, that was really nice to see you come around and see the benefits. So it's pretty widely accepted right now that, the Fed is going to raise rates within some time in the near future without guessing, but it's expected by the end of the year, at least 50, perhaps even 100 basis points. So that makes lending, more expensive for the consumer. How do you see that impacting your securities-based lending business, if at all?
Well, first of all, floating rate product is really great for us because our cost of funds floats with the market. So having an asset that also floats with the market is attractive. And secondly, the demand for other credit products may slow, like residential mortgages, for example, in a rising interest rate environment, whereas the factors that drive clients' demand for securities-based lending really are not affected as much by rising interest rates because it's a short-term use of funds, usually a bridge type financing. So we see it as a good option. There's also, as you talk about the capital markets and asset classes and rising interest rates over the last 10 years, the market's been favorable to our clients and they have some appreciation. So having the ability for them to tap into that liquidity without having to sell assets and have tax impact, is a consideration in the markets that we're currently in, with tax rates likely rising.
Yeah, now that's a dual-edged sword, I think you bring up. In my years of doing this business, an appreciated market is your friend because there are a lot of assets that people don't want to liquidate for, capital gains and tax reasons. But as we've seen over the last week, markets can correct, right? And so if you're writing loans against highly appreciated assets, how does a bank, especially, somebody like yourself with a credit background, how do you make yourself comfortable being aggressive in a market that can move and, the collateral sort of underpinning these loans certainly could drop in the foreseeable future? How do you get comfortable in an environment like that?
Well, good question. I'm going to turn it over to Keith Avant because he's been, very much involved in the implementation of the technology we're using going forward to monitor these assets. In the past, it would take us at least a day to understand the impact of the market on this portfolio, and the software we were using also didn't really look at concentrations of assets within this asset class. So in other words, the collateral concentrations within this portfolio. So Keith, I'd like to hear your thoughts as well on how you feel this technology or use of technology helps us in a volatile market.
Sure. I think the first thing that you've got to do when you take a look at the risk profile of this type of lending is communicate with your client, understand what their investment strategy is and what their risk profile is. Because as we talked about, rising markets are great. When the market starts correcting or coming back down, that's when your risk as a bank starts to creep in. But if you know up front, what their strategy is, what their risk profile is, you need to know how much you can lever their portfolio. So I think one of the most important things to do is understand the client before you see the market reactions. Understand how much you can lever their portfolio. Understand how much dry powder they have outside of it. So you can lever one portfolio if you want, but if that's all they have and they write checks out of the account, et cetera, that might not be an appropriate way to raise capital for them. Understand that they can meet a margin call. Stay in constant contact with them. So we have a fiduciary relationship not only to manage their money, but we also have a fiduciary relationship not to over-lever them and stay in contact with them. Make sure that you have a good way to tell them when they're coming close to a margin call or a collateral call. You have to stay in contact with them. The worst thing in the world is for you to onboard a client, the market falls, and you all of a sudden have a market, you know, a margin call. So what we'd like to do is we have, you know, they're getting close. We pick up the phone, we call them, we send them a letter, we send them an email, whatever it is, that however we communicate with our clients, and then let them know, hey, you're kind of getting close, right? We've already originally underwritten. We know that at the end of the day, they're good quality clients. They probably have some outside liquidity to cover a margin call. So we've covered all those bases up front. As they start getting close to a margin call, we step in and start talking to them about how they'll cover a margin call.
Excellent. Thank you.